Welcome to this in review video update, and we hope that all advisors and stockbrokers and investors and shareholders are safe during this ongoing global pandemic. Today I'm speaking with Magellan's co-founder, Chief Investment Officer and Lead Portfolio Manager, Hamish Douglas. Now, Hamish, there's a bit of a theme going on with our discussion today. And the first question is around Donald Rumsfeld, obviously well known for his description of known knowns and known unknowns. Can you explain why this is kind of relevant when assessing the COVID-19 crisis?
Well, Frank, good to see you doing this remotely with you today in our work from home. But I notice you're in a work from office environment where I'm in a work from home environment today. And a very interesting question. And in my investor letter to everyone, I framed the Donald Rumsfeld famous quote about the known knowns and the known unknowns. You know, this is actually a very useful framework for really assessing nearly any problem. So what you do here is you list down all the facts as you know them. Some of those facts are pretty certain because you know the answers to certain of the facts. You could ask, well, what is the stock market today? How high is it? And you'll know the facts of what the price earnings multiple and where it is and where it's been relative to history. And then you may have a whole series of things you know to ask the question about a situation, but you actually don't know how it's going to play out. And those are what are known as unknown or known unknowns in that case. It is really the known unknowns. You know, what are the uncertain facts about a situation? And what we tend to do is we tend to get locked into a course of action. And then when we assess facts, we have something that's called confirmation bias. And we also have something called an overconfidence tendency. So some of the uncertainties you may dismiss away, or you may find facts that keep confirming your case. And by listing down all the things that you know about a situation and whether you feel quite confident you know the answer or you don't know the answer, by listing them down, you start to getting a frame of reference about your level of confidence you have in a situation. And this is very, very relevant about the current situation because there are so many, when you list it all out, there are so many what is known as the known unknowns, you know, a whole series of questions you have, and the answers to those questions could have a very material impact on the way forward. And that's what you have to do. You could have a whole lot of questions you could think about, but how they turn out could be completely immaterial. So what you then have to assess is what's material and what isn't material. And the things that are material, how uncertain are they to then get your level of confidence? And it's to really overcome our own heuristic biases, particularly confirmation bias here. And I would really say to anyone who's looking at a complex problem, you know, list down all the known knowns and all the known unknowns in a situation. And I think that will frame about how confident you feel about the way forward and not just lock into a single scenario and then really just dismiss everything. And I think there's a tendency for people to oversimplify things at the moment because they haven't done the homework around the totality of the situation.
And so when it comes to the virus, what are the known unknowns that concern you most?
Well, the first thing I'd say, Frank, what concerns me a lot is there are so many known unknowns. Often in situations like this, you get a few things, but some of them are not that material and you can put probabilities on them. The problem about this particular situation is there are just so many material uncertainties, and that makes this situation incredibly unique in terms of things we've looked at in the sort of last 13 years. And I would say it's more complex than 2008 and 2009 because really you had to just assess the health of the financial system and really what the regulators were doing about that in the financial system. You know, if we start to go through some of these material known unknowns, the first one comes to the virus itself. Scientists still know little about the virus. And that's a very important fact. You know, us generalists may read some articles and get excited about a vaccine or excited about a therapeutic, or think the mortality rate's going down in the United States, or us going out of our homes, we're just personally feeling more comfortable. But it's a virus and it's incredibly complex. And the closer you get to the scientists, the more you come to appreciate how little we actually know at the moment. So that's a very important fact. That leading into probably is the next issue, I would say, is really about the duration of the pandemic. You know, there is huge uncertainty about whether we're going to get a vaccine or a therapeutic effectively in 6 months, or whether we never have one at all, or whether we get there in 12 months or 18 months. The duration that this takes is fundamentally going to drive the outcome economically for all of us invested in markets. And there is just a huge range of outcome. And I don't think anybody other than just guessing could narrow that down. Even the scientists who are doing all the research on these vaccines and therapeutics at the moment, they couldn't give you an answer that. You know, the next thing I would say here is a major unknown here is, you know, it is likely we're going to get a major second wave of the virus in the Northern Hemisphere as they enter their winter at the end of this year. What is going to be the consequences of that? Will they be able to keep these economies open? Even if they keep the economies open, how will individuals behave? And we learned from Sweden, even though they kept their economy open, they still had a large impact. And we're starting to see as this virus is spreading in the United States at the moment again, notwithstanding many economies have opened and continue to open up, we're starting to see a slowdown in some important statistics around behaviours, but it was initially accelerating dramatically the economic recovery. The next big issue that I would say that's very on our minds is emerging markets. Emerging markets are looking quite benign at the moment, but the virus is looking anything but benign. And the issue you then go to is, where will we be in 6 months or so in some of the major emerging markets? And what could be the economic consequences for those countries? And what could be the spillover effects for global markets, which really comes me down to my very last major known unknown. And this is the one that I think is the most important one for investors, is people have become overconfident in what I would call the central bank put. The central banks have been so aggressive here in implementing programs in March, and they have been very effective in calming markets down. And they've targeted lending markets, money market funds, currency markets, the treasury market. They've purchased over $3 trillion worth of assets in the United States, the Federal Reserve. But the market has extrapolated this, that whatever happens, the Fed's going to pull out a bazooka and shoot it. And therefore, people have become complacent that, don't worry, the Federal Reserve is going to save us. But the issue is there are limits on what the central banks can do. And particularly if we enter a crisis in emerging markets or a crisis in the high yield lending markets, these are areas that are at the absolute outer limits of what the Federal Reserve and other central banks can do. And it will require governments to step into the void, and maybe governments collectively on a global basis to step into the void, not the central banks. And the probabilities where we are politically in the world of that happening looks pretty low. So all I would say is people at the moment are either unaware of the limits of the central bank's ability, or are just hoping we never get to test them. And there are, I would say, smouldering bushfires that could get ignited later this year if we get a real surgence in emerging markets, which would lead to a capital outflow beyond the capacity of effectively a secured lending facility the Fed has set up to protect currencies in emerging markets. But if they run out of US dollar collateral, hold on to your chairs, I would say. And that may be exactly the same time that we have a US election. And they're not going to be very focused on bailing out emerging markets. I'm not saying it's going to happen, but there are areas where I think people have become overconfident in the power of the central bankers because they've acted with such force, and I would say so effectively. I'm a great fan of what's been done, and they've taken lessons from 08, 09 here. But there are limits, and people not understanding those limits is dangerous, in my opinion. If those risks emerge, they could be catastrophic, but that doesn't mean they're going to emerge. No. They're foreseeable risks. That doesn't mean they're going to happen.
No. And Hamish, you alluded to this earlier. There is no cure, there's no treatment, and there's no vaccine for COVID-19. But yet there's lots of research going on. What, in your mind, are the chances of finding a vaccine, and what are the known unknowns surrounding a vaccine solution?
Well, first of all, I would say is I don't know if a vaccine is going to be found or not. And I find it very hard to put a probability on a vaccine. And I think a lot of generalists are putting fairly high probabilities on a vaccine being discovered. There is some good news there, okay? So you need to weigh up the good news. The scientists didn't start from scratch here. They had done a lot of work into other coronaviruses, namely MERS and SARS. And they had learned from that effectively the thing that's called the spike protein, the S protein, that attaches the virus to a human cell where it infects the cells and how it spreads within the human body. And because they had known that, and it was so similar through the DNA sequencing that they had done early on, that the immunologists who are looking for the vaccine know what to target. And so that is an advantage. Another advantage here, it appears to be very slowly mutating here. You know, HIV, which emerged in the early 1980s, they predicted in 1984, the HIV virus, there would be a vaccine with the amount of research being undertaken within 2 years. 40 years later, we do not have a vaccine for HIV, despite enormous global research on that topic. And scientists are hopeful we may get a vaccine quite soon today. That's 40 years later. HIV is particularly difficult because it mutates nearly on every infection. So this is different. It mutates slowly, which would give you a greater sense of hope here. And the other thing of hope, I would say, is just the coordination and the quantum of research going on globally here and the collaboration that's happening. There's over 100 vaccines under development. We have over 10 in clinical trials. At the moment, the regulators are trying to truncate both the testing of vaccines and pre-investing in manufacturing for vaccines. So, you know, there's a lot of irons in the fire, and that would give you some hope. There's the best minds in the world with a lot of money, with a lot of government support, with a lot of collaboration going on here. But then what are some of the known unknowns here? I'll start with the bad news is coronaviruses are well known. They've been well researched, and no vaccine has ever been found for a coronavirus to date. So, you know, we have to put some reality on this as well. You know, what they don't know is a number of these early trials in animals and others, they believe they're getting an immune response, creating antibodies. But the scientists don't know what level of immune response is required to be effectively triggered by a vaccine to create protection. So that is still an unknown question from any of these trials. A vaccine is also going to require very extensive testing. You are effectively infecting a person with the virus. You want to know it's safe because this virus is deadly. It's going to require a test of maybe 60,000 people in all different demographics and people types here. And there's a lot of failure rate in testing vaccines. So even though it's worked in a chimpanzee or a mouse, doesn't give you comfort that it's going to pass a full human trial. And a sobering fact is the dengue vaccine that was rolled out globally after clinical trials actually had an adverse over-response reaction in children in the Philippines. And after it had been fully trialled and fully rolled out, the dengue vaccine then was pulled from the global markets because it was killing people. And there is some evidence that with coronaviruses, a vaccine may well trigger an adverse immune response in certain people. So the vaccine could actually kill people by vaccinating them. So that's why these safety tests are so important. And we haven't got into the safety tests in any of these vaccines. They're just starting now. The next thing a vaccine needs to do, it needs to give you long-term protection. And any influenza or coronavirus, it's very difficult for a vaccine to give you long-term protection. We don't have any long-term protection vaccine for influenza. We have to get a new vaccine every single year. And the only way knowing whether or not a vaccine that they find is truly going to give you immunity for the long term is what is called longitudinal studies. They are time-based studies. It's very, very hard to truncate time. So everyone goes, we're going to get there in a thing, but even when we get to a vaccine, there will be questions they still don't know the answer to about the long-term effectiveness. And probably the most important thing about this particular virus, the mortality really affects the elderly. And a lot of vaccines do not work very well with old people. So they may find a vaccine, but it may not be effective in providing immunity to the people who need it the most. So that is another real challenge here with a vaccine. But there is hope. There is just enormous amount of research going on. They know what they're aiming at here. The scientists are hopeful maybe in the next 12 months we'll get to a vaccine. The effectiveness of that vaccine and the ability to scale it and everything else. But the hope that we're going to have a vaccine widely distributed at the end of this year is a possibility, but I wouldn't put a high probability on that outcome from what we know today. And I put this down a bit like an analogy that it's a bit like gold mining. You sink a drill, you get an assay and you find some gold down at 230 metres to 235 metres, and then people decide they're going to extrapolate an entire ore body from that. At the moment, we have a few drill holes and we have some very limited data from a few drill holes around some vaccines. And people are extrapolating those single drill holes into the entire ore body at the moment. And the scientists are looking at saying is, they are shocked by the media commentary and things around some of this vaccine at the moment, going, hey, hang on, it's very, very early days here. And we're way away from data and things that could extrapolate the end outcome. But that doesn't mean with all this research going on, and there's been amazing breakthroughs in medical science in the past, and therefore I'd be hopeful we're going to get there, but I'm not going to become overconfident at this point in time from the data we have.
Hamish, you alluded to the economic uncertainties that are out there. What are the risks that you consider the most worrying, and are there any that people aren't actually talking about that are concerning as well?
Yeah, the first one is a very good question, Frank. The first one is We don't know the extent of the economic damage at the moment. Because of these stimulus programs, we actually don't know what the level of unemployment really is. And if you think about it, in America, there's been 20 million people who have lost their jobs, according to the unemployment statistics. But like Australia, where we have the JobKeeper program, they've got the Paycheck Protection program, where businesses are being effectively lent money that will be forgiven if they keep people on their payrolls, and that money can be used to pay people to stay on. All those people who effectively would have otherwise been laid off are not in the unemployment statistics. And those people may well think they've got a job, but the businesses may never have an intention of keeping these people. So we don't have visibility about the true level of unemployment, and we don't know how businesses are going to change how they operate. We don't know the bankruptcies ahead. We don't know how banks are going to act when they stop. At the moment, there's forbearance. The banks are just allowing you to defer your mortgage payments and other things. That when the clock starts ticking again, really, what is it going to look like economically? And I think we're kind of in a dead calm zone where there is just limited visibility on what the real damage looks like. And the damage will depend on the duration of the pandemic. You know, if this all ends in 6 months and we have a vaccine, yeah, maybe businesses will keep people on. But if it goes for another 12 months, it could be a very, very different picture. What are the areas where people are not talking about? You know, there is a lot of conversation about the end of the economic bridge and the fiscal cliff and everything else. So what I was saying there probably isn't surprising, but it's very hard to estimate. And people may be getting overconfident in some of the spending patterns coming back at the moment. One, people have been locked up and haven't spent anything, and a lot of them are getting stimulus checks from the government and think that they have a job at the moment. If that uncertainty goes up and that stimulus goes away, you know, we'll then really see what the economy looks like. The other one, I would say, the risks that people aren't talking about, and I spoke about this earlier, about the limits of what the central banks can do. And the two big areas on our mind that we can see where a major catastrophe could happen would be in emerging markets. And in many emerging markets, the virus is accelerating out of control. So you really try and fast forward where they could be in 6 months' time economically. And there are scenarios where we get a crisis in some major emerging markets, which would put their currencies under crisis as capital flight starts happening, as was happening in early March. But that's calmed right down at the moment. So everyone go, oh, it's all calm and everyone could do it. But if it builds up at that point, the problem is there is only so much the central banks, and particularly the US Federal Reserve, because they're the critical one, because in that time, people demand dollars. So much of their lending is done in US dollars. And in order to get dollars, to keep those US dollars in their system, they need to sell their own currency. And to do that will drive their currencies through the floor. That causes the crisis, that causes more and more people to want to get their money out. It becomes a run on the currency. And to calm that down, they need to get dollars outside the exchange rate mechanism. And that's where the Federal Reserve is currently stepping in with a very inventive lending program in the United States, where any central bank, and nearly every central bank, well, there'll be few, North Korea wouldn't have an account, but most central banks have an account with the New York Fed, and they have holdings of US dollar assets, particularly US government bonds or treasuries, as they're known. They hold them on deposit in America, and the US Federal Reserve is saying that you can give us as security your US government bonds, and we will put into your accounts US dollars. But if they use up that facility and they run out of collateral, the US Federal Reserve is not going to lend these countries money on an unsecured basis. And they're not going to take collateral that isn't super high quality in US dollars, based in the US of A, where the Federal Reserve has their hands on it. And that is the calamity. And the only way to then rescue an emerging market or multiple emerging markets that could be happening simultaneously would be a global bailout. And has anyone known there's an election in November in the United States and there's something called America First? Do you think the politicians are going to start pumping trillions of dollars and led by the United States in bailing out and Europe bailing out other countries around the world? I think that's a very low probability. So I'm not saying it's going to happen, but it's completely foreseeable because the virus is accelerating in these countries. Yet volatility is really low, and the markets are not pricing that risk at all at the moment. And the other area of risk, I would say, is in lending markets around the world. The US corporate bond market is 10 trillion US dollars. 40% of those loans are rated BBB. Around 2 to 2.5 trillion of those loans are already sub-investment grade. If we get further economic stress later this year and into next year, a whole lot of that BBB loans will be downgraded to sub-investment grade, which means the people who are holding them are no longer able to hold them. And if we have defaults in the sub-investment grade space, that is an area in which the Fed can't help. So I'm just talking about there are limits here that if this gets uglier, you could see a crisis evolving in something called the fallen angel space and the sort of leverage lending space. And some of this is wrapped up in exotic instruments called collateralized loan obligations. And these are held and been packaged to investors. This sounds a little bit like subprime because it is like subprime. It just hasn't happened. The Fed has put programs in place to try and head off some of that risk because they can see that risk. They put the program in place for emerging markets because they can see that risk that I'm talking about. But there are limits in what they can do. And we haven't yet seen a crisis in either of those two spaces. And if the economic situation gets bad enough later this year or early next year because of the virus, and this is all coming back, the virus is incredibly uncertain. Because of the virus, if it leads to more economic pain, you could see those bushfires igniting. And that is an area that we're incredibly focused on at the moment. But it requires a deterioration in the economic scenario, and it requires, bankruptcies in the high yield markets, and it requires, investors losing confidence in the emerging markets because of the economic situation that could get triggered by a pandemic running out of control in those countries.
So, Hamish, if enough of these known unknowns turn out for the worst, markets could collapse. Can you talk us through how you're thinking in that type of scenario?
Yeah, well, first of all, I think it's very important to frame what I've actually said here. I know newspapers will have the headlines, Douglas says markets to collapse. That isn't exactly what I've said. First of all, I said is I don't know what's going to happen and what the pathway forward is, but it's completely foreseeable at the moment that we could have a relatively benign outcome here, that as we're opening economies, we manage the opening of economies, we get to a vaccine or an effective therapeutic, which would be a cure, dramatically reducing mortality sometime later this year, early next year. We handle the second wave. And in that world, we're going to have very low interest rates, and it is foreseeable the markets could well grind higher in that world. So almost what the markets are pricing at the moment, but it's also foreseeable in some of the things we've just discussed, we don't get to a cure. Some of these vaccine trials, or nearly all of them, fail or get extended out in their time frame. We get a major second wave in the Northern Hemisphere later this year as they go into winter. Banks start foreclosing onto loans. Emerging markets enter crisis territory. Bankruptcies start happening. Hundreds and hundreds of billions of dollars of corporate bonds in America get downgraded and around the world. And we enter into a real crisis type territory financially. And we entered a very deep and prolonged recession. In that world, if that starts happening, it is foreseeable a collapse in equity markets. And, markets had sold off 35% through March. A collapse would be above that, okay? So maybe I'd frame this as it is foreseeable at the moment of a grind higher over the next 12 months, maybe plus 20%, and it's foreseeable markets plunge 50% as a broad sort of spectrum here. Which direction is it going to take? I don't know, Frank. It depends on so many interdependent variables, depending about which pathway we go down. Because the data seems to be supporting the plus 20 scenario, we seem to be exiting this. People are now moving around. We're talking about vaccines. We're talking about therapeutics. There's very low volatility in markets. Emerging markets seem to be stable. Everyone thinks we've got a Federal Reserve put on any uncertainty. It's not surprising where markets are pricing things at the moment with that information, and people react to the environment they're in at the moment. But we don't know what environment we're going to be in 6 months time, and I'm not going to speculate on that environment because I genuinely don't know. I can see both pictures, and that worries me. But I'm not going to tell you a collapse is going to happen because I don't know a collapse is going to happen. But I'm not going to get overconfident that it's not going to happen and bet we're going to be in the recovery in the low interest rate scenario with low volatility out 6 months or from now, because I frankly have no idea, Frank, that what's going to happen.
So not kind of unrelated. There are lots of known knowns and there are lots of known unknowns around the virus, around a cure, around economic impact. How are you responding in managing the portfolio?
Yeah, well, we're cautious at the moment, Frank. I feel very comfortable with the hand that we are covering at the moment. You know, we've got 16% odd cash in the portfolio at the moment. We've taken our risk ratio down in our portfolio. You know, it was running at 0.8, which is our cap. It's now running at sort of 0.66 in the portfolio. We have sold a lot of things we call discretionary stuff that's really dependent upon the economy. We've sold down that, like we've sold down our luxury exposures, which we think are fabulous long-term companies, but they're very, very dependent in the next 3 or 4 years, depending on what the economies are doing. So Louis Vuitton, which is a company I think enormously of, we've sold right down to a very, very small position. We've effectively sold out of the big emerging market exposed companies. We had 2 large brewers, Heineken and ABI. We're sold out of those companies mainly because we just think there is so much uncertainty. They're 50% in Latin America and Africa effectively. And you don't want to make a call what's going to happen in those areas of the world because I think it's unknowable at the moment. You know, we've sold down one of our favourite stocks, HCA, which is the largest hospital operator in the United States of America. We made a lot of money in that stock, and we think the world of the management and its positioning, but there's a huge amount of uncertainty in the virus. You know, at the moment, there are 2 big states of Florida and Texas. They make money out of elective surgery. It's very hard to do elective surgery when all your ICU facilities filled up with people with coronavirus. And we may well get in the next few weeks those facilities getting overwhelmed with patients and nearing capacity, but not fully at capacity at the moment. And we've got election, which could change healthcare policy at the end of this year. But in our portfolio, the rest of it, we've got a very good balance between cash and super defensive businesses like Crown Castle and Reckitt Benckiser and Nestle and our utilities and other investments. They're very well positioned. We're very comfortable about Microsoft and SAP and 2 great Chinese tech companies, Tencent and Alibaba. We think they're very well positioned. But with the defensive, we've got growth. Those companies are growth companies. We also own Facebook and Alphabet, Visa and MasterCard. They're all growth companies. So, you know, we will give up a little bit on the upside if people start backing the cyclical recovery story as they have been in the last 6 weeks. But we're not going to lose any sleep over that. We row our own boat. I think taking out some insurance like we have and lowering our risk and holding some cash at the moment, given what the risk reward is at the moment, is a very sensible thing to do. If it turns out the markets keep grinding higher and assuming we haven't got out of cash, because we need some more evidence to put the probabilities on that, frankly, with you around the virus. Until we have more evidence, we're just not going to speculate on that. Data is important to us. If markets grind higher, 20%, if markets are up 20 and we're up 17 because we've given up 3% because of the 15, 16% we've had in cash, I'm not going to lose any sleep over that, Frank. But I can tell you, if markets plummet by 50%, you'd want to hold our hand over most other hands. And I think that's a pretty sensible way to think. We'll get most of the participation if markets keep going up, but we have a lot of protection now, and actually more protection than we had coming into this, because we're running a lower risk portfolio. Notwithstanding, our portfolio by design held up very well through this period leading into March.
So, Hamish, if Biden beats Trump at the US elections in November, what effect do you anticipate this to have on markets, and how are you positioning the portfolio in the event of that happening?
Well, first of all, it's not as simple as if Biden beats Trump. It really matters here about what happens in Congress, and what happens in the Senate, and what happens to the White House. Those three is known as the trifecta here. At the moment, there's about a 30% probability in betting markets that Biden would take the trifecta, that they would win a majority in Congress, a majority in the Senate, and win the presidential side of things. So if they don't win the trifecta, I would say there'll be gridlock in Washington, and therefore there's probably not going to be a lot of legislative agenda. And that scenario probably doesn't worry us at all, and maybe it'll be a little bit calmer than we currently have the situation. Although Trump is very, very pro-markets. If they get the trifecta, I think one of the first things they're going to do is roll back some of the tax cuts that were put in place, and Biden's been quite clear on that. Trump cut the corporate tax rate from 35% to 21% and changed the nature of international taxation. Biden has said he's going to reverse that, and he's going to increase the corporate tax rate to 28%. And he's going to change the nature of some of the taxation of US companies on a global basis. That is a negative for profitability, maybe 8 to 10% hit to profitability. So it's not enormous, it's not a collapse in markets, but it's an impact. And obviously we're running the sensitivities across our whole portfolio around that. The nice thing is only something like utilities, they get to pass it through. So it doesn't really have any impact. Non-US businesses, it has a marginal impact about the tax that they pay in the United States. It's not that big a issue. How far they go ultimately in a recession environment, given it's going to be a fiscal contraction at the time, is going to be interesting. But there are some negativities around profits. Do we think it's going to lead to a collapse in markets? No. Do you think some of the trade issues may be a less of an issue? So there are some pluses and minuses, but Trump is probably more positive for markets than Biden is. But are we panicking about that? No, we're just looking at our portfolio, thinking about the sensitivity of the valuations to particularly a taxation change in the United States. And there may be some other changes around healthcare policy and extension of Obamacare and so forth. We're not exposed at the moment because we've really sold down the HCA position that we have to that. But that's a material issue for that particular investment about where healthcare policy may go. But you need a trifecta here. And it's not straight up and down, because even a trifecta doesn't get you all legislation. You need to get to 60% of the Senate to get yourself absolute control. You can pass taxation changes with a 51% majority, but you can't pass normal legislation without a 60% majority, because there's something called a filibuster in the United States. So you need some, and therefore the more radical forms of sort of reform is probably unlikely. There. So, and I don't think Biden's going to be on the radical side of reform.
Lots of commentators are suggesting that as a result of COVID-19, the digital transformation has accelerated by up to 3 years. And that would kind of suggest that businesses like a Facebook and Amazon, Microsoft, Alphabet, and so on are even more competitive than ever before and more dominant. Does this increase the risk of a regulator stepping in to break up those businesses?
Yeah, well, first of all, your statement is, yes, their business models are accelerating. Are they becoming more powerful? That was a trend that was happening. It's probably a trend that is accelerating. So these businesses are taking more and more market share, becoming more dominant, more powerful. There are limits in which regulators can act here in terms of their antitrust authority. These were approved acquisitions, and some of it's grown organically. And there's probably limits in what the Department of Justice and others can really do here in enforcement of the antitrust legislation. And therefore, you may well need legislative change to do that. And that's where I think it really runs into some trouble if you need legislative change here. Because there is very divided views. You know, this is a winning part of America, and do they really want to handicap their most competitive part of their economy versus on a global basis here? And therefore, I think to get the legislation through to really put a new act to break up these companies is a big hurdle. But even if they were broken up, and you know, Amazon and AWS was separated, and Microsoft had to separate their cloud platform from other businesses, or Alphabet had to separate YouTube out, or Facebook had to break up Instagram and WhatsApp and others, is the sum of the parts is probably worth more than the whole. And therefore, that's probably not the regulatory risk. We put a low probability, but it's a regulatory risk where the share prices will probably go up in the short term rather than down. I think they're better because of the data and everything they have of holding them together. Maybe the AWS business could legitimately be separated from Amazon. I think what you're really concerned about this question on regulatory risk is, you know, doing things or putting in place sort of orders that they can't behave in certain ways, and that's more likely where the Federal Trade Commission or the Department of Justice or the European Commission puts in orders that effectively stops Apple using its App Store in a way, and the commissions it charges because they've effectively got a monopoly on that, or stopping vertical search, you know, where Google directs its own customers in search results to its own shopping service versus other shopping services, or limiting the amount of data that can be used, third-party data collections and things that gives them less signals in those businesses. I would put those type of regulatory interventions, which really goes to the behaviour of these tech platforms, as much higher probabilities. They're not death blows in any ways, and where they're still probably going to be the most efficient mousetraps around for what they do, but it will have an impact ultimately on their economics. But blowing these whole things and breaking them up, that's probably not the biggest thing on our agenda. But more surgical regulatory interventions here that could have an economic consequence on their business models, that is something that is right on the top of our agendas.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching this In Review Global Update. As always, feel free to forward the link on to clients, friends, family, colleagues, as you see fit. Please stay safe, and thanks again for watching.